I'm finished.
In development studies. And she'll be talking about the financial sector and the role of the financial sector in economic growth, specifically how competing theories conceptualize this. So please join me in welcoming Natalia.
Okay, hi everyone. Is the mic working? Okay. Okay, so I think we'll just start with the very basic question: what is the purpose of the financial sector? Because although it seems like something really obvious, it's actually not at all, and there's actually a huge amount of debate even over this extremely basic thing. So just to be clear, for the purposes of this lecture, I'm going to define the purpose of the financial sector as allocating financial resources. Oh, sorry. There's the definition. So allocating financial resources to those areas that are optimal for economic development as understood in traditional development theories, in adequate quantities and at appropriate prices. So taking this definition has important implications, and I'll talk more about that later on. Whether the financial sector is efficient or not is judged by how much it's helping economic development, so purely by this. And whether it makes development policies, especially selective industrial policies that you guys have learned quite a bit about in earlier lectures, easier or harder to pursue. So this means that more common measures of the efficiency of the financial sector that you've probably already come across at some point, like financial deepening indicators such as stock market indices or financial institution profitability, these are actually not important in themselves at all. So these don't matter in themselves. Furthermore, an important theme running through this lecture is that the financial system should allocate credit to productive rather than unproductive sectors. And these are quite common terms used in the literature, but they're actually not very clearly defined. So in keeping with the definition of economic development that has been spoken about in previous lectures by Yostin, Vasiliki, and Ivan, productive sectors will refer to real sector lending, especially to sectors that have the potential for productivity growth, employment generation, and to create positive externalities for the economy, such as manufacturing or agricultural sectors. Unproductive sectors, on the other hand, refer to either financial market speculation, real estate speculation, or consumer finance, which are not considered to have much scope for productivity increase, employment generation, or positive externalities, and in some cases can even have negative externalities. So this is quite a blunt definition, obviously, but it's still quite useful for our purposes today because we have to draw the line somewhere. Okay, so now this definition that I've given you of the purpose of the financial system is quite a vague statement, and it doesn't actually say much about the types of financial structure or institutions that are desirable. And that debate is what will be the subject of the lecture today. So at this point, we should note that the type of financial system we have can have either disruptive or supportive effects on the process that I mentioned, the allocation of resources to those sectors that will create economic growth. So I'll just say clearly now, quickly summarizing the argument that I will be making in this lecture. So even though the ideal financial sector in neoclassical economics is a liberalized one, the historical experiences of successfully developed countries has been the opposite. That is a heavily controlled financial sector in the service of an industrial policy in order to promote economic development. So let's take a quick look now at what the various theories say about what types of financial institutions and governmental roles lead to positive outcomes. So due to time constraints, this explanation will be quite brief, but I would encourage you to have a look at the readings that I'm going to put up later to get a more nuanced picture, because obviously in 5 minutes, I'm not really going to do justice to the neoclassical theory of finance and development. So the neoclassical literature on finance and development started as basically an empirical literature in the 90s, which used cross-country regressions to show a positive association between financial sector growth, what is termed financial deepening in the literature, which is basically the size of the financial sector, and economic growth. This literature has been flourishing for over 20 years now, so it's a massive theoretical and empirical literature, and they use quite sophisticated techniques to try and establish a causation running from financial deepening to economic growth. So given this is a huge literature and specifies so many different channels and mechanisms through which financial deepening causes economic growth, I won't go through each of them, but I've put up a list of some of the main ones here for you to just have a look and read in your own time. But the thing to note here is that in all of these channels, the basic mechanism is an efficient market-based allocation of resources. So the literature doesn't really deal very explicitly with the role of the government, but when it does, its ideal role is seen as only to set the kind of necessary policy and institutional preconditions for financial deepening and provide some kind of financial safety net to deal with crisis. But following on from this, when the government intervenes excessively, it's seen to prevent growth due to distortions in the free market price allocation process that this causes. On top of that, its provision of the safety net can cause financial crisis due to moral hazards, which I'm sure is something you guys have all heard about after the recent crisis. So therefore, the policy recommendations coming out of this literature would be things designed to minimize the allocative influence of government and allow the market mechanism to work. So this would include stuff like financial deregulation, domestic financial deregulation, privatization of banks, capital account liberalization on the external side, removal of interest controls, capital market development policies, etc., etc. And jointly, these things have often been termed financial liberalization. So I should just quickly point out that the recent literature that has followed the crisis has become slightly more critical of this stance, saying now that financial sector growth beyond a certain level in advanced economies can actually have a detrimental effect on growth, but without actually questioning these basic mechanisms. So before we go on to discuss some of the alternative approaches to the question of finance and development, let's just make explicit a number of assumptions that this literature, the neoclassical literature, relies on, even in the post-crisis environment. So one of its core assumptions that I'm sure will sound familiar to all of you is the efficient markets hypothesis. And this is the belief that financial markets allocate resources efficiently. That is, prices reflect all information both quickly and accurately. So relatedly, the assumption behind economic growth is that it comes through a market-based allocation of resources. And I won't elaborate on this because, of course, you've already discussed a lot about neoclassical versus alternative growth theories. But in this regard, its assumptions about the role of the government as merely a facilitator or a provider of infrastructure are also severely problematic, especially when you know from previous lectures that you know about the major role the state has played historically in actively promoting economic development. So apart from these problematic assumptions, there are a number of other things the literature has come under criticism for. Aside from the numerous methodological problems that I won't get into, much of the empirical literature looks at financial sector size as the independent variable in a very kind of unsophisticated way. The financial deepening indicators are usually things like bank lending to and stock market turnover or market capitalization to GDP, and they're not really able to account for institutional differences in the financial system. So what I mean by this is that, for example, an expansion in the size of public development banks means something completely different for economic growth than an expansion in the trading activities of a hedge fund. But if you take this kind of blunt financial deepening indicator without differentiating, they might show up as the same thing. So now, I'm actually not going to go into a lot of detail on the different theories of financial market behavior because I want to leave time to talk more about industrial policy and give some empirical examples as well. But just very quickly, in many of the alternative schools of economic thought that you guys have learned about in these lectures, like Keynesian, post-Keynesian, institutionalist, Marxist, etc., the efficient markets hypothesis assumption is rejected. There is no belief that financial markets left to their own devices will always allocate resources in the optimal way. So in these theories, there's no such thing as a true market price or an intrinsic value. This has dramatically different implications for the role of the government in the financial sector. So it's no longer assumed that markets left on their own will allocate resources in the best way for economic growth, but rather that they need to be made to allocate resources in this way by the government or by the state. So this brings us to the role of the financial sector in industrial policy. And it's this historically important role that actually the neoclassical literature has completely neglected. So just to recap, industrial policy is basically when the government intervenes in the economy to promote certain sectors over others, usually the manufacturing sectors, in order to promote economic development. But as this has been discussed quite extensively, I won't go into that. So in this view, the role of the financial sector is to support industrial policy through providing low-cost credit to priority sectors and not through a market-based allocation of resources, but rather the opposite, through state control. So this has been termed financial repression, in case that term sounds familiar to anyone, by pro-liberalization economists in debates that came up in the 70s, when over-excessive government intervention is supposed to have had some negative effects, and it's supposed to have a negative connotation actually. But in this lecture, I'm just going to take it to mean a government-controlled financial system. So this line of thinking brings us back to the works of a famous economist, Alexander Gerschenkron. According to the Gerschenkron hypothesis, the more underdeveloped a country, the stronger the institution required to promote economic development. So in the case of the financial sector, since private investors are too risk-averse to undertake the type of large-scale, long-term projects needed for economic development, the government needs to do this instead. And this is done through controlling the financial sector through things like government ownership of banks, controlling interest rates, and directed credit programs. So I won't go through all of these, but this is a list, and it's not exhaustive, of the main policy tools that have historically been used in financial repression. And I'll instead try and explain how some of them work through some country cases. So we'll see now in a bit more concrete terms how countries have historically utilized methods of financial repression in the context of an overall industrial policy in order to promote economic growth. So I'll talk about only a few specific cases here so that we can get an idea for the different types of policy tools that were used and how these were used. But of course, many more countries have used these kind of methods. And if you want to read more, I'll put up more case studies on the reading list. So first, I'll talk about the two very well-known cases of Japan and Taiwan. Then if I have time, I'll talk about two lesser known but potentially more interesting cases, Germany and Pakistan. So Okay, so in Japan, in the rapid development phase, in the post-war period, you had a financial system dominated by the main banks, as they were called, which were large commercial banks which had long-term relationships with the most important large firms. Though these banks were privately owned, the government played an important role in determining the overall financial structure through limiting competition in banking using entry barriers and other regulations. So the capital markets, which are supposed to be an important source of long-term credit, were actually actively prevented from developing by the government. So there were actually no or not very large capital markets during Japan's rapid development phase. And by capital markets, I mean stock and bond markets. So instead, there existed publicly or privately owned long-term credit banks to provide credit for fixed investments. And the difference between these and the commercial banks were their funding sources. So while the commercial banks are funded by individual deposits, which enable them to lend only short-term, and so finance mainly short-term working capital loans, the LTCBs are actually funded by their own bond issues, which are much longer term, and therefore enable them to make much longer term loans without as much risk that their funding sources will be withdrawn. So the LTCBs actually played a vital role in Japan's rapid development by providing funds to strategic sectors designated by the government as part of the industrial policy. So in Japan, these included power generation, steel, coal, fertilizer, shipbuilding, and also by providing joint loans with the main banks. Then in Taiwan, it's a similar case, except that the government actually used even more extensively the tools of repression to influence the amount and the composition of investment in order to implement its sectoral industrial policies. So in Taiwan, the banks were actually all government owned. And again, sorry, I'm talking about Taiwan in the post-war period, so up until around the 80s or 90s. So the banks were all government owned, and the advantage of government ownership of banks is that it's easier for the government to direct the banks to lend to the areas that it thinks is important. Of course, this is still possible with private banks, as was the case in Japan, but it requires a much stronger regulatory capacity of the state, which Taiwan did not have at this time. Also, government banks can lend to far higher risk industries as the government can bail them out. So this basically means they don't have to lend on a short-term profit motive, but they can afford to lend to unprofitable sectors for long periods of time, which is the essence of industrial policy. So the government in Taiwan also controlled the interest rate structure. This means that interest rates for different things were not market determined as a spread to the main policy rate, as we're used to thinking about in the UK, for example. But rather, the government would just set an interest rate for important sectors. So for example, there would be a different rate for deposits, a different one for lending, and different interest rates for lending to different industries. So if the government wanted to encourage, say, the shipping industry, it would just put a much lower interest rate for loans to the shipping industry than, say, for consumer finance. So in addition to this, there were also directed credit schemes, which offered credit at subsidized rates to certain sectors that the government wished to promote, such as the export sector. At some points, the banks would even receive lending targets, so that's specifying a certain amount that they have to lend to, say, 6 to 12 important industries, which were deemed as the priority sectors by the planning agency and the central bank. So what's maybe more interesting is that it's not only late developers from East Asia that have utilized industrial policy and financial repression in order to grow, but actually many of today's advanced countries have also used some of these methods during their industrialization phases and even in the present day, actually. So in France, for example, public development banks played a key historical role in industrial development. And I'll include on the reading list some readings by Kindleberger and Cameron, which actually provide a really interesting, detailed economic history about how the German, French, Belgian, Austrian, and Italian banking systems have contributed to economic development. A more unexpected example, which I'll talk about in some detail now, is present-day Germany, which is actually home to one of the world's largest state-owned development banks, the KfW, which was founded after World War II and has played a significant role in German economic growth since then, and still continues to do so today. So that is the full name in German, if there are any German speakers here who can pronounce it. So the KfW was originally set up in 1948 to channel the Marshall Plan funds into the German economy. Its role has since evolved over the years, and today it focuses on three main areas. So one is climate and environment, one is SMEs, and the third is internationalization and technology promotion for large German firms. So the way the KfW works is that it's divided into a number of smaller subsidiaries, which each have more specialized functions. So the Mittelstand Bank is the SME bank, and the Communal Bank provides finance to municipal governments. So these two form the domestic operations of KfW. Then we have the KfW IPEX Bank, which provides large German firms with long-term credit and trade finance in order to help them internationalize and become competitive in the international economy. Then there is KfW Development Bank, which finances investments in developing countries. And people say this is to basically create a market for German products in developing countries. So one sector that German industrial policy has been promoting now, today, is the renewable energies sector. So being a new sector, the renewable energies area has not so far been able to develop on its own. One of its key difficulties was in obtaining finance. So this is due, of course, to the uncertain and highly risky nature of being an innovative sector, but also being a long gestation and capital intensive sector. So as renewable energies are still in the early phases, they're actually much more costly than traditional energy sources, and therefore they actually don't have very much consumer demand. The situation is now gradually changing, but as I'll talk about a bit more, that's due to government measures. So the German promotion of the renewable sector started in the late 70s, but it actually only really took off after 1997. So although it was actually Denmark who had the first mover advantage in the sector, Germany has now successfully caught up with Denmark. It now has the largest domestic world market share at about 35 to 40% of the world renewable energies. And it's becoming more and more competitive internationally with the large Danish firms, which are the leaders in the area. And it's done this, so the large German firms have become competitive with the Danish ones through the help of financing from KfW IPEX Bank. So let's see in a bit more detail how Germany achieved such success in the renewables sector despite a late start. So a key part of its policy to promote renewables has been feed-in tariffs to create demand for renewables amongst the electricity suppliers. But another key component that makes the investment possible has been large-scale subsidized lending, which is offered through state institutions. So all of KfW's subsidiaries mentioned above lend to renewables. And they actually have a quota to lend 35% of all their commitments to the renewable sector. As we can see from this graph, which maybe you can't read super well, so KfW's renewables lending has increased very significantly from the early 2000s. If I had a graph showing you in the 90s, it's even lower. And so this is, the red one is the total amount of lending KfW is doing to the renewable sector. And what's actually interesting is that you can see in 2010, it really goes up. And that's because KfW is also providing a counter-cyclical function during the aftermath of the financial crisis. The blue line is the percentage of finance for renewables that KfW is providing out of the total in Germany. So this is at about between 30 to 35%, which is extremely high. It's much higher here because before there was really no other financing for renewables. So KfW is basically providing like nearly half of total renewables lending. So KfW has a number of specific promotional programs, which are basically the same thing as directed credit schemes that were going on in developing countries for renewable energies, in which it guarantees long-term, low fixed interest rate loans. So how does its company structure enable it to do this? Because the normal private bank cannot really do things like this. Okay, so first of all, KfW works by disbursing its loans through other banks, so through savings banks, cooperative banks, and commercial banks. And the reason for this is that these local banks already know their clients well and can do a much better risk assessment than KfW could do itself. So KfW provides refinance to the lending bank and assumes part of the loan risk as well, allowing the lending bank to make a low risk profit. So in a sense, there's no reason the lending bank would not agree to do this. It also acts as a lead bank for consortium lending for very large projects. And some of the very large offshore wind projects that have been undertaken recently were only made possible through this consortium function of KfW. So how does it fund itself? Okay, when the Marshall Plan ended in 1953, the European Recovery Program Special Fund was actually turned into a revolving fund for long-term investment loans. So what this means is that all the profit that they got from their investment, they would basically just put it back into the fund. And in that way, the fund actually kept growing rather than shrinking, even once the Marshall Plan was over. So this fund grew over the decades due to interest being accrued, and this special fund is still used today actually to finance KfW's favorable lending to what it terms as its promotional sectors. So the value of the ERP fund, last I have data, was about 8 billion euros 2007, which is quite significant. KfW also takes advantage of the fact that it's a German state institution to raise money on the international bond markets at extremely low interest rates. So it issues a large number of different types of bonds in a number of different currencies. So this basically means that KfW has access to cheaper and longer term funds than a normal bank. And this is what enables it to lend to its promotional programs, including renewables at subsidized interest rates and longer term loans. Because remember, a normal bank relies on deposits, which are generally more expensive and much shorter term. Okay, so now moving to in the last 10 minutes, the quite different case of Pakistan, which has undergone extensive financial liberalization and bank privatization. So it's a good case because basically what has happened in Pakistan after these reforms is actually quite similar to what's happened in many developing countries. So this pattern is actually quite common. I've heard from colleagues it's going on as well in Turkey, Ghana, Nigeria, and I mean many others. And there's not been much research done on the pattern that happens after liberalization. So it's interesting to look more into this. So let's look at what has happened in terms of lending and investment patterns in Pakistan after liberalization. So I'll just begin by very briefly describing the pre-reform system. So from the 1970s to the late 80s, before the reforms, which took place in from the late 80s to throughout the 90s and then the 2000s as well. So the Pakistani financial system was a typical repressed financial system with government-owned banks, including a number of specialized public development banks, which were responsible for long-term lending, and then 5 commercial banks, which were responsible for short-term working capital lending. There was also credit planning, controlled interest rates, and directed credit schemes. So really the kind of typical repressed financial sector that I described earlier. So from 1989 onwards, when Pakistan came under an IMF structural adjustment program, there was extensive liberalization of the financial sector with a move towards market-determined interest rates and privatization of the commercial banks. So these reforms really gathered steam in the mid-90s and then continued throughout the 2000s, as I just said. So the public development banks were eventually eliminated or merged with commercial banks, and they no longer exist today. So let's see what the outcome of these reforms have been. So this first chart, so each of these are the 5 large commercial banks, and this chart shows the profitability of these banks. The red line is the beginning of the financial reforms. So the thing to note here is that post 2004, the 5 large banks started making very, very large profits. So that's here. And even after 2008, that's here, the profits remain very high. And this is really strange because the economy is in a recession at this time. So the bank should not be making high profits. So how can we explain this? By the way, this is also taken as proof that the privatization was a great success amongst policymakers. So let's go back to what I said earlier about how we measure the success of the financial sector and how profitability indicators are actually not a great indicator of whether the financial sector is performing its function or not. So if we look at the credit extended to the private sector, which is this graph over here, we see that this is actually falling really dramatically after liberalization. So this means that the bank profitability is not coming from lending to the real economy. And also note that before the reforms took place, a lot of economic activity went on in the public sector. This only shows the private sector. So in fact, it's a huge overestimation of how much credit historically is being provided. So actually the fall is even much greater than it seems in this graph. So if profitability is not coming from the real sector as it should, then where is it coming from? So the first answer is unproductive investments in consumer finance. So this actually resulted in a bubble which burst in 2007, causing the consumer finance divisions of many banks to actually be closed down, and not to mention the many people who had huge amounts of debt and then got into a lot of trouble. So once the consumer finance bubble burst, the banks started investing very heavily in government bonds. So this is a graph of the government bond investments of the large 5 commercial banks again. And you can see that after 2007, that's when the consumer finance bubble bursts, the government bond investments suddenly go very high. So this was because the government bond market had previously been liberalized. So before the financial sector reforms, what would happen is that the publicly owned commercial banks would basically be forced to lend to the government at fixed interest rates of about 4 to 6%. So after interest rate liberalization, the government bond yield went up to 12 to 13%. So this means that banks are basically making a risk-free profit. 12 to 13% is a lot. It's a massive, massive return. They would probably not even get that much for real sector lending. So the banks are making a huge risk-free profit from government bonds, while this brings the government even further into debt because it has to pay, it has massive domestic interest payments due to the banks. It's now stuck in a vicious circle where it's borrowing more and more just to pay the high interest rates. And this is something, actually this exact thing with the government bonds is something that is happening in a lot of developing countries. So with bank profits coming from such unproductive sectors, it's no surprise that the real sector, especially the manufacturing sector, has suffered. So according to a World Bank report in 2009, nearly 80% of investment funding among Pakistani manufacturing firms comes from retained earnings. So that's this graph over here. This is the domestic sources of long-term investment finance. The largest one by far, and this is only for manufacturing firms. The largest one here is internal funds, which is not normal for a developing country. It should be much, much lower than external funding. Commercial banks are barely providing anything. It's about 10% of their funding, which is really, really bizarre for a developing country. The state-owned banks, since they're mostly gone now, are providing 1% or something like that. Non-bank institutions includes stock markets and this kind of thing, and as you can see, they're insignificant as well, because normally in developing countries, unless the government really pushes it, it's difficult for companies to raise finance on the stock markets because they're anyway perceived as very risky and no one really wants to invest in them. So in short, the financial system is really not performing its function. If the financial system is only lending to the government at very high interest rates, but not doing any real sector lending, whether it's profitable or not doesn't really matter. That's not really the point of banks. So this has had a really negative effect on investment in the economy. Both private and public investment has declined, and we've seen deindustrialization in the Pakistani economy. And especially sectors like heavy machinery, engineering, steel and automobiles that were the most reliant on government funds have been the most affected. So the main point that I've tried to make is that the financial reforms, especially the elimination of the development banks, have left Pakistan with a financial sector that's institutionally unable to perform the required functions that banks have historically played in developing countries. And that is to provide investment credit to the productive sectors of the economy. So, I'm nearly finished. So in conclusion, very quickly, the point is that there are many different methods and many combinations of methods that the government can use to influence credit allocation to varying degrees. Not, of course, that every government needs to do exactly what Japan or Taiwan did. I think that the Pakistani case is useful to show that there are certain roles that only publicly controlled financial institutions can play in late industrialization, that private commercial banks left to their own devices just cannot play. The German case, on the other hand, shows that even in today's advanced economies, using the financial system to support selective industrial policy is actually alive and well, even though it's not framed as such. And in Germany, it's been really successful in the case of renewable energies. So as a final point, I think it's quite interesting to compare Germany with the UK, where even though RBS was nationalized after the financial crisis and the Bank of England has been doing quantitative easing in the name of preserving free markets, the government actually did not put any kind of conditions or regulations on where the banks would lend, despite the fact that they got government bailouts. So as a result, of course, they did not really improve their real economy lending after the crisis. So a recent statistic from Positive Money shows that only 8% of bank lending in the UK goes to the real economy, to real economy businesses, and while the other 92% of bank lending goes into property market speculation and financial markets. Okay, that's it. Thank you very much. So we can have 10 minutes of questions. Yeah.
Hi, thanks. That was really cool. I just have a question. It's more just on the transition from, because you said that after the Marshall Plan, Germany, then what happened to the ERP? Could you just explain that again?
Oh, okay. So during the Marshall Plan, the ERP was the fund that basically was channeled to KfW and this one other development bank that was later merged with KfW actually. So that was a special fund used to that was channeled through these banks and into the real economy. So what happened when the Marshall Plan ended was that rather than just get rid of this fund, they kept it there and they turned it into a revolving fund. And all that means is that any profits made from the investments of this fund were put back into the fund at the end. So in that way, the fund kept on growing. So it's still here today, basically. Any other questions? Yeah.
You focus, well, thanks for the talk, very interesting. You focus mostly on the role of lending in supporting development. But as you mentioned at the very end of your talk, a large part of the financial sector is about speculation. There is anything else would you like to add about that part of the financial sector? Probably for time constraints we didn't add it during the talk.
But in what sense? You mean in terms of the negative implications of that or the potential positive implications?
Well, I think it's very difficult to make the case for lending to the real economic sectors when their profitability is much lower than the financial sector.
Yeah.
Therefore, a liberalized market will be very difficult to correct itself.
Yeah.
So therefore, where should we aim in terms of policy?
Yeah, I mean, so this is a problem, right? That financial market speculation is more profitable than real economy lending, and this is why you see what's been termed in the literature financialization of non-financial corporations. So when even non-financial companies actually start earning a large part of their profits from financial market speculation. And I mean, so there's been a whole literature on how this is harmful to the economy. It creates financial fragilities, can cause financial crisis. So of course, I mean, the policy implication from that is to go back to real economy lending, which is the point of banks especially. How financial markets are supposed to contribute to the I mean, because that is also their purpose, right? Stock and bond markets. Actually, the original purpose or how it's justified in economic terms is not to enhance profits for speculators, but it's also supposed to provide capital to the real economy. So how that works in a stock market is only through the IPO. So the company actually only gets capital when an IPO is done, so the initial stock offering. And companies do raise capital this way. The problem is that any activity on the secondary market doesn't actually give the company anything. How that's justified economically is that it improves price discovery or price efficiency. So the idea is that if a firm does badly, the stock price will decline and then they will get taken over by a much more efficient management. But this, of course, relies on the assumption that the financial market price reflects something accurate or reflects reality. And if this doesn't hold, then in the end you could say that's actually all pointless and companies are getting taken over for no reason. So I mean, I think the obvious policy implication on this is that, or at least for developing countries, which are actually being very actively encouraged to develop their financial markets by the Asian Development Bank and the World Bank, is not to do this, because I mean, if you look at countries like Korea, Japan, Taiwan, they actually didn't have financial markets when they developed. So you actually don't need, not only do you not need this for economic development, but it can also pull resources out of the areas that actually need them for economic development. So the obvious policy implication is to not develop financial markets if you're a developing country, especially if there are many other things you could do at the moment. But then once you say, as you say, once it's already, once this is already happening, of course, like many other dynamics come into play and many vested interests. It's not just about what is the best policy. Yeah.
I think it's an error historically to try to divide speculation in the financial markets from development of the real economy, especially at the frontier. Not playing catch-up, but pushing the frontier when investments have an extremely uncertain potential return. So from the investment that created the British railway system in the 1840s through the great internet bubble of the 1990s by way of the electrification of the American economy in the 1920s, capital was mobilized for the real economy at the frontier in enormous quantities through financial bubbles. If anybody wants to learn more about this, I'll be lecturing on productive bubbles in the Mead Room on Tuesday at 2 o'clock. But I have to go do my lecture this Tuesday. I'm sorry, on Thursday at 2 o'clock in the Mead Room. So there's a deep tie between financial speculation and investment in transformational innovation.
So can I just ask, sorry, when you say at the frontier, what do you mean?
I mean the frontier of technology where you don't know.
So not developed, not late industrialization.
Not the Gencron,
yeah.
but pushing forward from the frontier.
Yeah.
Yeah.
Thank
Great lecture, by the way.
Thanks. Anyone else? Yeah.
The thing is that I'm curious is that the reason why you had, post-war European economic growth and, like the golden age, right, in the glorious 30s was because you had American, political pressure on Western Europe to do this kind of, have this kind of selective industrial policy to not engage in financial speculation, which was obviously kind of an obvious policy choice because of the Great Depression, right? So my question is, I guess, is what are the constraints now for such a kind of selective industrial policy to come back? Why is that seem so kind of out of reach?
But I guess the first kind of broader thing is that, of course, in the post-war era, it was, we were living in a completely different economic paradigm. That was at the time of Bretton Woods and closed capital accounts. Keynesian ideas were much more prevalent than now, of course. So, and this, it's not so much that the US encouraged industrial policy, but more that it didn't really mind because, so there are competing explanations for why this happened, but one of them is that because of the Cold War, it was actually, because it wanted to get Europe as allies, it was much more lax about trade policies and stuff. So the US, in principle, wanted free trade even at this time, which, as you know, probably is an important aspect of industrial policy as well. But because it had to make trade-offs in getting allies again for the Cold War, it was actually willing to let some of these things slide. The international environment is, of course, really, really different now. One of the main things being open capital accounts and financial globalization, which, I won't get into the reasons for that, but which has, of course, created a self-sustaining dynamic where now more and more companies and banks have gone into financial market investments as their core business. So, I guess on the one side, in order to do these kind of financial policies, you need closed capital accounts because they don't work when you have open capital accounts. That in itself is a huge political hurdle. Then domestically as well, because now that you have you have a liberalized domestic financial sector, the corresponding interest structures have changed. So let's take Pakistan, for example, because I spoke about it. Now it's politically impossible to not forget renationalizing the banks, but even to put controls on the banks in terms of where they lend, because now they're foreign owned. So if you did anything like that, it would become a diplomatic incident. So, I mean, it's hard to say unless we're talking about a specific case, but all of these things together, I think, have created massive constraints to these kind of policies. Although, I mean, that being said, of course, we do see after the financial crisis a slight turn back in the opposite direction, and one of the main things being the IMF's new attitude towards capital controls. So now the IMF actually even recommends capital controls in some cases for developing countries.
Okay, I think time's up. Thank you very much, Natalia.
Thank you.
So for those who are interested in this topic, next week's CSEP talk will be also on the role of the financial system. That's on the 24th. There's no CSEP talk this week, actually. And next week in Paper Zero, we'll be hearing from myself. And I'll be talking about the economics of climate change. So I hope to see you all next week. And again, thank you for coming. Thank you.